go and look forward into 2023, I think a lot of these things will reverse. So I think we are looking at a situation where things will mean revert as you move forward. And first, the most challenging part for us has been inflation. Amit, just let's move to the next slide. Yeah. So again, move forward.
Neeraj, your is turned off. Can you please turn it on?
Sorry?
I think your video is turned off. Can you turn it on?
The host will have to,
Nidhi, you'll have to enable it. Right now, it's...
Please enable my video.
One.
Nidhi?
Yeah, Nirav, Amit is doing that.
Yeah. So the host will enable this. Inflation, I think we are pretty clear that, we are behind the worst in terms of inflation. We want to call it peak inflation. We don't know the pace of the moderation, but if you look at any of the high frequency indicators, whether it is the container rates, whether it is the dry bulk rates, whether it is the semiconductor issues, whether it is the agri prices, or whether even if you look at commodities, broadly most of the things are down 15 or 20%, 25% from the peak. And please appreciate the fact that inflation is a YOY phenomena, right? It is not an absolute level of prices, which means that as we move forward into the next year, our own expectations are that we'll probably get to about 5.5% by Q4. RBI's own expectations are about 5% in Q1 as we move forward. So inflation, and to me, the biggest risk to equity markets over the medium term and the long term always remains inflation. And I think we've done a phenomenally good job in terms of controlling inflation, given what the developed markets have been facing all this while. And to some extent, I think that reflects in the resilience of the markets as well. And like I said, I'm happy to take questions around this, but I think we are very clear that we are past that phase of inflation. I am not a great believer of what is usually called this the labor price spiral. It is not there in India. It is not there in US. In US, when you go back into 1980s, the unionized labor force was close to about 30%. Today, it is less than 11%, right? So while the Fed has to be more vocal in terms of trying to rein in inflation expectations, I think we need to read between the lines. And I won't be surprised, for example, if Fed would be done with most of these rate hikes, probably one more rate hikes to come in February. We'll have two more inflation prints coming by then. And I think then they'll probably pause, and depending upon how the growth numbers play out, may even start cutting the rates later in the year. So you're past that steep curve of interest rate increases. Amit, next slide, please. These are about the earnings that I talked about. We track this labor hourly earnings. But like I said, the key takeaway for you guys is essentially the fact that it is not going to be a circular problem. Inflation is not going to be a circular problem, not in India, not globally. Move on. I just want to catch the high parts. So this is interesting. It basically tells you that every recession itself is a disinflationary phenomena, right? So we don't know how long. So what are the odds of US getting into recession? Very difficult for us to make a case. It is slightly technical. So I don't want to get too much into it. But if you believe that the supply curve in US is steep, which we believe, that means that you will have a very, very low pullback in aggregate demand for inflation to come down, right? So at least that is our base case, but we'll have to see as more and more data points come across. The next slide, please. I just referred to this about the labor price and the wages not moving in tandem. Next slide. DXY. Next slide, and I'll spend some time over this. This is important. How dollar moves is very, very important, because if I need to explain this to you, these sort of dislocates our own monetary policy to what the economy demands. So if you have a situation where DXY rallies strongly, which means that people then try and sell emerging market currencies, which means that you start losing liquidity, which means that RBI will have to increase the interest rates to defend rupee, which means that even if my economy cannot take high rates, I'll have to face those high rates, right? So that is obviously, so you are, even today, you are a pillion rider, right? And US obviously has a benefit of being what you call the owner of the reserve currency, right? Why did we escape the problem that we faced in 2013 QE taper, right? There was a big chaos. We had current account deficit problems then. We had current account deficit problems in the current year. We barely nudged. And the reason for that, our starting liquidity, if you go back in Jan, Feb, our starting liquidity at the repo window was 8 lakh crores. Which means that you could absorb 30, 40, 50 billion dollars of money moving out of the system without impacting the liquidity in the system. Right? And if you actually read, yesterday RBI's deputy governor has given a very nice interview and talking about the fact that we should look at surplus liquidity now, even when we are raising the interest rates, right? So she has made a case for that. So it is very important. But like I said, to us, we are done and dusted again with the strength in the DXY that we have seen. Amit, next slide, please. Different emerging markets are going to be hit differently depending upon the stage of the economic growth. But it is suffice to say that if Fed is behind the steep increase in rates, then we are behind the strength in DXY. It doesn't necessarily mean that DXY will have to fall. It can be a sideways movement. It can even fall. But as long as it doesn't rally very strongly, we are home. Next slide, please. What does it imply for India? Next slide. So the most critical thing, and like I said, you guys will have access to the presentation. I think the key takeaway for us is that we are not firing as well as the other developed markets are. Right. So even today, when we look at it, we are just about 5% above our pre-pandemic GDP growth estimates. We are below the trend line. We did not overstimulate. We have not seen, inflation getting out of control like what you have seen in other parts of the world. To that extent, we don't necessarily have to tighten as much. And I think RBI governor has done a phenomenal job so far, right? While trying to so it's a very fine balance, right? So because you also want to build your credibility, you don't have 30, 40 years of credibility like Fed has got, which means that when you talk, people should take you seriously. When I talk about not investors, not only necessarily investors, but public at large, which means that you need to rein in inflation expectations. At the same point of time, you don't want to increase the rates because you want to protect the growth. And I think, so my own personal view is that my economist has probably a different view. I won't be surprised, for example, if we are done with increasing interest rates, right? And obviously, we'll have to see in terms of incremental data points. I'm not too worried about inflation. I've talked about it, right? I also believe that Fed is at fag end of his interest rate increases. And I don't think we need to increase our interest rates from where we are at this point of time, because we still have a very, very clear K-shaped recovery. Urban is doing very well. Rural is not doing well. Right. And you don't want to tilt the balance right now. So you just want to drag, you want to drag out these global headwinds that we are facing right now and then take control of your monetary policy again. Next. Here we are just talking about the channels of inflation. It can happen through exchange rate. It can happen through credit growth. I only tend to look at credit growth. Next slide, please. Can we pass this slide as well? This is important. The channel through which inflation actually gets into, through lower interest rates is to credit, right? For the first time, we have seen credit growth picking up. We are just coming out of decadal lows. And then also you need to sort of temper that with the fact that your real credit growth is lower because you had a very high inflation rate to start with, right? So you try and deflate that by CPI and see what is the real credit growth rate. So we are very early in the cycle, and which is why one of the case that we make RBI should be far more cautious in terms of raising the rates further, because I don't think that inflation is our worry at this point of time. It is time to refocus back on the growth itself. Next, please. Next slide. Our estimates are at 5%. RBI will stop at 5.75. Maybe some of the market expectations are at 6.25. I don't think that 15-25 basis points makes too much of a difference, as long as we know that we are coming to a pause more than anything else. Next. There is a bit of worry that you got. So you've got, broadly speaking, your three elements of growth. You've got consumption, which is urban and rural. Then you got investments, which is government, state and center, and private corporate capex and the real estate. And then you got exports and imports, a summation of that, right? Export is something that we are genuinely worried about, because obviously you are not immune to what happens globally. And therefore you again fall back on the same argument, which is whether you will have a short recession or you'll escape a recession or you'll have a longer recession. We don't have answers to that so far, but it's fair. It's just wise to model that you will have some drag on our own growth rates from what is happening globally through the export channels. Next. Indian markets, people tend to look at emerging market peers. We have done very well. I will not overemphasize emerging market peers, because China has done what it has done and it enters into that basket, and therefore the valuations and they look pretty high. It is like looking at Bajaj Finance valuation as compared to a Punjab National Bank, right? So one is a PSU, one is a private sector. So is India vis-a-vis China. So you need to adjust for the fact that the regulatory risk in China are significantly higher today than what they were 2 years back. Next. Our starting points are not too great in terms of the valuation. We need to be cognizant. So we are very bullish, but that doesn't mean that you blindly buy the markets. There are a lot of bottom opportunities. Sanjay will talk about that. But relative returns will moderate, because obviously some of the other countries have become very cheap as well, including what is happening in China. Some of the near monopoly sectors are trading at single-digit valuations. So the relative returns is what you are referring to over here. Next. Growth outlook, I just referred to it quickly. We talked about the problem in the rural markets. We are bullish on the investment cycle. All the three legs that I referred to, including real estate. Next. Sanjay, you want to take over from earnings?
Yeah. Okay, so before we head into what we are thinking of Nifty in terms of earnings outlook, where we are currently on valuations, just want to summarize, why the markets have done well in the last 12 months for us. I mean, obviously India has stand out in terms of resilient GDP growth rate. Also, importantly, the growth differential vis-a-vis rest of the world, that has been fairly high. We have seen growth estimates, forecasts being cut everywhere, even for India. And we are not done with the cycle overall, whether for India, rest of the world, but the growth differential remains quite high. And that has been helping India vis-a-vis rest of the world, particularly the EMs. We have seen very healthy growth in corporate earnings, low teens growth this year after a very strong growth in FY22. And inflation control has been pretty good in India. But most importantly, the domestic equity flows have been very robust, and they have very handsomely absorbed a lot of the FIS selling which has happened, particularly in the first half of the year. And although it started in the third quarter of 2021. So these are some of the reasons. And now we are already seeing some reversal FII equity outflows as well, and that is supporting the valuations, which are not cheap. And I'll come to that later. Just also to summarize the outlook on the macros, yes, there will be some more interest rate hike, particularly in the US. We may also see another 25 pips hike, although inflation is well in control. So that our outlook is that next year inflation will be around between 5.5%. 10-year GSEC yields, they've been uncapped. They've been below 7.5% for over 6 months now. Currently 7.3%. We don't see any flare up over there now that we are ending the interest rate hike cycle. Fiscal deficit also remains under control, should come at under 6.5% of nominal GDP for this year, fiscal year, broadly in line with what the government has targeted. Current account deficit, not very different from consensus. Our forecast is around 3.5% of GDP, $120 billion. BOP will be negative, $50-60 billion. It will be negative in FY24 as well, but it will be closer to neutrality, compared to this year. A lot depends on the extent of capital, inflows next year. Finally, on the rupee, it has depreciated, and I would say, to some extent that may help why some of the FII flows have reversed. So the interest rate hike in the US has been quite aggressive, as Nirav mentioned, more than 400 basis points within a year. And whereas, RBI has raised the repo rate by 225 basis points so far. So we have been lagging on the interest rate hike, partly because the inflation has been lower, but some of the brunt has been borne by the rupee, which has depreciated. And that now we don't see significant depreciation in the rupee. Much of that is already done. So these are our broad macro views. Overall, if you look at the macros, Indian macros are worse off compared to the pre-pandemic level, but at the margin, things are improving. And that is the good news, on every front, whether you look at CAD, inflation, BOP, INR, at the margin, things are improving. Certainly, they're not worsening. That is what one can say. From a near-term point of view, I think there are only two issues. One is a little bit of interest rate hike, which is left, right? We are going to approach the peak repo rate very soon by February, around 6.5%. And at the margin, growth forecasts are still being trimmed. If you look at last RBI forecast, which came out in the MPC, 6.8% real GDP growth for fiscal 23. And I think we started the year before the Russia-Ukraine war broke out. We were around 7.5%, a little more than that. So growth forecasts have been cut. And that is a near-term issue, I would say, for India, particularly in the context of what is happening globally, in terms of the recession fears, growth slowdown, and that is going to impact India also at the margin. Perhaps most of that is already reflected in the forecast, but we'll have to wait and see. And that's a near-term issue. Also, rural recovery has not been, it's still subpar. As again Nirav mentioned, is a K-shaped recovery. But yeah, ahead of election, perhaps government will take care of some of the, maybe there'll be, stronger rural spending, and that can lift up the sentiment next year. But that remains an issue. Urban consumption has been very robust. A lot of it is pent-up demand post, full reopening after COVID. But again, high inflation, interest rates hike, they tend to impact consumption also with a lag. So again, that's a very near-term issue. We are very bullish from, on a 12-month horizon and beyond that. But on the next 3 to 6 months, we may have to see how corporate earnings pan out, particularly on the consumption, discretionary consumption front. So this is the broad sort of a macro backdrop in terms of which is guiding how we are looking at the market. Now, coming to the Nifty earnings, if you look at the slide, this is slide number 24, I think. Yeah. So as I mentioned, this fiscal year, we're expecting Nifty earnings, Nifty 50 EPS to grow at 13%. But next year, it's much better. A lot of it is coming from banks and the fact that the auto sector cycle will continue to gather steam. And also the fact that some of the sectors which are suffering from high inflation in terms of margin pressure this year on the consumer side, they will start doing better as the commodity prices have come off. So that is going to help. So that's why there is a stronger growth projected for FY24 in Nifty EPS compared to this year. FY23 EPS since the beginning of the year has been cut by 4-5%. Okay, since the Russia-Ukraine conflict broke out. FY24 EPS has also been trimmed, but by much lower amount, 3%. So at this point in time, we don't see material risk to FY23 earnings. There is some risk to FY24 earnings. Consensus forecast is 18% growth YOY. This may be a bit lower, but the chances are pretty high that the growth next year in EPS for Nifty will be better than this year. Some risk, as I mentioned, global growth slowdown, some impact on the domestic consumption of monetary tightening and inflation this year. So this is the forecast for growth. On a 2-year basis, if I look at CAGR, we are looking at a mid-teen earnings growth for Nifty this year and next fiscal year. If we go to the next slide, a lot of the Nifty earnings in previous year, FY22, if you look at the table at the bottom left, this came from low PE stocks, commodity stocks. They really rallied, particularly in the second half of last fiscal year, and that contributed to Nifty 50 earnings growth significantly. Having said that, the earnings contribution of the high PE sector, some of the secular growth sector and some of the growth cyclicals also, be it auto, banks, it was quite robust last year as well, 32%. And this year, we're projecting 27%. So on a high base, of course, the growth rates are coming down, but quite handsome. But the low PE sector, the commodity, metals, oil and gas, those sectors are going to see an earnings decline this year as commodities have cooled off. So the bottom, the sum, total of all this is that the Nifty, the quality of Nifty's earnings growth, that is improving. More earnings are coming from high quality sector, high PE sector, growth sectors compared to the low PE sectors. So that is improving, that is normalizing from FY23 onwards. So that actually is a case for supporting higher Nifty PE multiples because the earnings quality is improving. Okay. Can we go to the next slide, please? Yeah. So this is how the Nifty earnings. So we talked about earnings growth and earnings outlook, earnings mix. If you look at the valuations, they are not very comforting. We are very close to 20 times. Look at the chart, at the top right, 20 times forward price to earnings. Last 10-year average has been 16 times, and last 15-year, I think there's some swapping here. Last 15-year is 17.2 times, not last 10-year. Last 10-year is 16 times. So last 10-year, the PE multiples, average PE multiples have improved. Yeah, so this is correct. Last 10 years, 17.2. There was an error in my presentation. So from 17 versus 17.2, which has been the average for the last 10 years, we are close to 20 times. And in that context, the multiples are expensive. The current multiples are actually one standard deviation higher than the last 10 year. So they're not very comforting. Earnings growth outlook is good, but the valuations are already sort of pricing in a lot of that. Our view is that broadly, market multiples can be higher than last 10-year average. Okay. Because India does stand out, domestic equity flows are robust, and there's a lot of cyclical sector which are going to do well. And earnings growth outlook is quite good, actually. We're talking about 18% at the consensus level, but even with some cuts, it will be higher than this fiscal year, which is projected at 13%. So that's a very good earnings growth outlook. So multiples can be supported higher than last 10 years. Whether they'll be 19 or 20 is difficult to say. I think that will be an optimistic case in my view. So if we look at multiples being somewhere around 18 and a half or so on 2024 earnings, then by December 23, we should have Nifty somewhere around 19,500. I think that, and we are going with that as a base case. Multiples slightly higher than last 10-year average, but lower than where we are currently. So we are actually looking at, in our base case, some PE derating to happen for the market over the next 12 months. Okay. In the bull case, if the multiples were to sustain here, FII outflows sort of structurally sort of reverse in a convincing way, domestic inflows remain strong, we could be at 19.5, 20 times as well. In that case, the Nifty 50 could be at 21,000. That's the optimistic or the upside case in our view. And if we look at the downside, let's say Nifty were to trade back at last 10-year average multiple, which is 17.2, then we are looking at roughly 17,500 as Nifty in 12 months' time by December 23, which means some downside, but not a whole lot. So overall, we still feel the risk reward is favorable. In our base case, Nifty will deliver single-digit return, around 7-8% over the next 12 months. And that assumes some derating from current levels. So next slide, again, we looked at the Nifty's multiple in a slightly different fashion. Looking at Nifty's earnings yield, inverse of the PE ratio, and comparing it to the 10-year bond yield. And we find that the gap is much lower than historically, around 200 basis points is the gap. So which means relative to the bond yields, the equity markets are slightly expensive compared to 10-year average. So just reiterating the same points that compared to historical averages, the markets are trading on a slightly higher side. And that is exactly the reason we have assumed that the PE multiples will derate from here over the next 6 to 12 months. So I don't want to spend too much on time on this. Nirav did mention that, Indian market have traded historically at a significant premium to MSCI EM. And currently there is even stronger case for an even higher premium for Indian markets vis-a-vis the MSCI emerging market index. And that is already the case. Currently, the markets are at a higher premium compared to historical averages. Coming to the sectors broadly that we favor in this environment, we have given a sense of where we are sort of more bullish. So essentially on an overall level, at the Nifty level, we're bullish on banks, particularly private sector banks and some small cap banks also. We're bullish on autos. We think that the cycle has legs and this will continue, particularly on the CV side. It will continue for another 2-3 years. We are still in early stages. We're bullish on insurance, secular growth story. Cement and building material, this flows from the fact that we are bullish on the capex cycle. We think it's a matter of time before the private corporate capex also picks up. The capacity utilization levels are high for the industry, and there is still momentum on the housing front. And central government capex remains strong, even though I would say state government capex has been lagging and they may not meet their budgeted numbers. But central government is certainly on track to meet its capex budget for this fiscal year. So that explains our view on cement and building material. We're also bullish on engineering and cap goods and to some extent on telecom. At an overall level, we are still underweight on IT. And that's again, this has, IT sector has underperformed Nifty. IT is down 25% this year. It is still hostage to recession fears in the DM. Much of that is, priced in our view. And therefore, we believe that some point in time in the next 6